welcome to the module on Foreign Exchange Market 2. Now the concept of foreign exchange goes to the back of conserving India's foreign exchange resources. This is very much in tune with the economy's financial strength in terms of globalness and also in terms of openness to the rest of the world. So the country was basically facing a kind of a trade deficit where the import bill was ever mounting, and also it was followed by the devaluation of the currency, and accordingly in terms of the foreign exchange reserves and other factors which was affecting the country's growth momentum also was increase in the price of the oil imports. So as a matter of fact, it is seen that in order to address the country's balance of payment problem, it is very much necessary to have an adequate reserves of foreign exchange, and thereby the accumulation of foreign exchange needs to be done. Even after accumulation, they require some kind of institutional procedures to be there or to be in place to make a good management of the foreign exchange reserves in terms of risk and other issues. So this goes back to the issue of the Act, which specifies that foreign exchange transactions were permitted between the Indian residents and the non-residents. So this is to be done in a way in order to conserve the foreign exchange reserves, how we can take care of a better management through the kind of act which are passed by the India after 1991. So this boils down to the concept of the Act of FERA, that is Foreign Exchange Regulation Act. So the Foreign Exchange Regulation Act deals with the laws which are basically related to the foreign exchange in India. This is very much relevant in the context of the laws and the mechanisms that are there within the FERA. And this also made it clear how to manage the foreign investment in India. Because by the time India was exposing itself to foreign capital, at that point of time foreign exchange reserves or the foreign investment is quite low or quite thin. So in order to build a more resilient mode of the economy, it is necessary to manage the foreign investments in India, which FERA has its origin at the time of Indian independence. So whenever the country is moving for Indian independence, at that time of point, FERA was its origin, but it became on a more bigger shape after the economy opened up to the global forces. This boils down to the issue of a temporary arrangement to control the flow of the foreign exchange. This is in the discussion to the colonialization that came place in India just before independence, because it is seen that there was a drainage of economic resources from the country to the rest of the world. So in order to prevent the drainage, some kind of better institutional framework is necessary. So in 1957, the act was made permanent, and as the industrialization grew in India, because that was the major policy which was taken up to revive the economy from the vicious traps of poverty or revive the economy from underdevelopment. So in 1956, the iron and steel industry was set up, and that was taken up by a heavy industrialization package when there was incentive to increase the foreign exchange investments. So such kind of move was there to protect it. So accordingly, we can say that the flow of the foreign exchange that was being done in the year 1956, industrialization also came up in India. So there was an increase in the foreign exchange investments. So this increase was basically manifold because it resulted to the growth of the country's benefits in terms of finance and other issues. So we invite the first question on this ground that discuss the backdrop of FERA. So with regard to the backdrop of FERA, we discussed the trade policy which was adopted in the Indian economy just after independence, and later on it was revived also so as to control the foreign exchange and also the flow of investments in a bigger shape. Then we have the adoption of the FERA Act, and the concept was then institutionalized with the help of a proper regulatory bodies. This boils down to what are the objectives of this FERA Act. The objectives were very much in tune with the openness, to facilitate the exporters, and also to make India a global platform, and so that India can search for a profitable export destination. The first objective is to prevent the outflow of Indian currency. This is very much in tune with keeping the reserves so that the leakages of the economy can be controlled. Secondly, to regulate the dealings in the foreign exchange and securities. This is actually calling for a good governance model to take care of the risk associated with the foreign exchange dealings. This goes back to the responsibility of the banks and other financial institutions which can do so to regulate the transaction indirectly affecting the foreign exchange. That means foreign exchange should not be compromised or it should not be surrendered in order to facilitate such transactions. That means foreign exchange flow should be consistent, but the transactions has to be monitored or regulated on time-to-time basis. To regulate import and export of currency and bullion. This is also regarding the exchange rate which is being said. Any fluctuations of the exchange rate should have an accommodative coverage by the central bank of the country, or the central bank must adopt an accommodative monetary policy to take care of the import and export issue of this exchange rate. Moreover, the FAIR Act also calls for some kind of export-oriented units to come up which will generate employment also for the domestic and for the foreign nationals. So once the employment is being done by the MNCs or the TNCs in the country, regulation of their employment status needs to be done. This is very much in tune with the regulation order that needs to be decided. To regulate the foreign companies, this is also very much important for a country like India to monitor, to regulate, to supervise all the MNCs which are operating across the sectors. The economy has opened up to invite MNCs, but government should have some kind of supervisory role over their performance and regulations, which can be done through the act passed in the cabinets. To regulate acquisition, holding, etc. of immovable property in India by the non-residents. So that means any kind of property transfer, any kind of mobility in the properties or acquisition of any infrastructural land or any other resource has to be controlled by the non-residents. To regulate the dealings in the foreign exchange and the securities, this is also very much important because foreign exchange and the securities are interlinked with each other, and thereby the dealings here refer to the transactions which are done mainly in the global and the digital platforms. Because there are huge degree of cyber risk associated with these dealings, so this act should look after some cyber laws, make some provisions, and also make the exporters cautious regarding such moves. Then the regulation of the transactions indirectly affecting the foreign exchange. For example, inflations, which may affect any goods and services, even the asset, even the debt accumulation of the banks, all these things can be related to the foreign exchange, so the monitoring has to be done on a proper manner. So this boils down to the question that what are the objectives of the FAIR? So prevent the outflow of the Indian currency, to regulate the dealings in the foreign exchange and the securities. These are the major two objectives. Apart from that, there are other secondary objectives of the FAIR. But the major objective is to prevent the outflow so that the country will not run in deficit or will be having the shortage of the currencies, because this will also build up the financial strength of a nation. At the same time, dealings in the foreign exchange and the securities has to be done on a regulated manner or in a phased manner. So now we are opening up from some of the regulatory provisions that are decided to take up for better implementation of the objectives. Because the objectives are set in the paper, but that needs to be addressed to proper implementation. So for better implementation, the provisions have to be done within the FAIR Act. The first provision is the regulation of dealing in foreign exchange. This calls for the foreign participators, calls for an effective clearing systems, and also how the logistic infrastructure can work on. Secondly, restriction on payments. This is very much important regarding any payment transfer that is being done. So any kind of payment transfer needs to be scrutinized, needs to go through a proper SWIFT code mode, and thereby the country can get access over it. So it has to qualify certain criteria, and then only the payment will be realized or delivered. Restriction regarding asset held by the non-residents and import and export of certain currency and bullion. This is regarding the asset movements, because it is said in Indian economy after full convertibility of rupee, any kind of asset purchase can be done by an Indian resident from any part of the world. However, there should be some checks and balances in all this type of transactions, particularly in terms of asset transactions. Duty on persons entitled to receive foreign exchange and payment for exported goods. This is basically a kind of a tax which may be imposed on a person who is actually receiving the foreign exchange so that the country can gain revenue from any such kind of dealings. Moreover, restriction on the appointment of certain persons and companies as agents or technical or management advisors in India. So whenever we are talking about management advisors or agents, we have to be very careful about the appointment policy or the recruitment policy so that they are not directly involved in the process of exchange dealings. Restriction on the establishment of the place of business in India. This is referring to the business operations which are being done. Because when we refer to the establishment of the place of business, it is basically referring to the advantages that that particular unit can come up. But that particular unit has to take care of the domestic foundations, has to take care of the domestic establishments, and then only it can be done. So this is basically a restriction done on the establishment of the place of business. This is very much inevitable in this regard because here we are referring to some of the advantages with that export-oriented unit may come up, but this has to go with the compliance of the government or of the domestic country. Prior permission of Reserve Bank required for taking up employment in India by nationals or foreign state. So that means any kind of regulatory mode in terms of the employment policy also needs to be checked out. Restrictions on immovable property. That is a property which is not mobile, any kind of restrictions that can be imposed on it. So we can invite a question in this regard that discuss the provisions. So when we are discussing the provisions, the first provision is regulation of dealing in the foreign exchange. This basically refers to the cyber risk or any kind of risk associated with the transaction policy. Secondly, restriction on the payment clearing systems, how more flexibly it can be done. Restriction on the asset which is held by the non-residents. This is regarding the asset delivery and the asset movement. And also how the duties can be entitled for foreign exchange and payment for exported goods. This is regarding the duties which are imposed on them and how the different provisions can be designed or ordered. Now we boil down to some of the amendments of the Act. This is very much important because the amendments were being added after the Act has been passed, taking care of the scenario of Indian economy. So one of the amendment was government proposed to introduce a comprehensive amendments for the changes in economic policy because this was being done before 1990s, but after 1990s the economy's orientation had a diametric transformation because economy had adopted more openness in terms of inviting foreign capital, promoting international trade and building on more an export-oriented models. So in tune with the changes in the economic policy, some of the amendments are being done in terms of liberalization of the industrial sector. This is actually inviting industrial sector some of the liberal norms in terms of delicensing and free entry of capital, and also inviting the economy to changes in the trade policy. This is also important how the trade policy can be oriented or it can be designed. Encouragement of the foreign investment. This is inviting the potential investors to come up to the foreign investors and also making the economy to be sound enough. Some policies must be there to build up sound infrastructure, world-class business environment and other factors which will be more attractive or which will be more conducive to attract foreign flows or foreign capital flows. All these are some of the amendments done in the FERA Act after the globalization policy took up. So as a result, the required changes were announced in the budget and which was issued by the notification of the RBI in this regard. So what were the important changes if we can identify? First, power of the central government to direct payment in foreign currency in certain cases. This is regarding the autonomy that should be given to the central government to take up the payment in foreign currency and thereby monitor all these transactions. Definitely it also refers to export and transfer of securities. Securities is more of a derivative market which can be mutual funds, debentures or any such kind of financial instrument which needs to be traded. So in this regard, the importance lies how the power of central government to come up and that is actually taken up on a nationwide policy. So now we can go for a question regarding what are the issues related to the Amendment Act. The first issue is government proposed to introduce comprehensive amendments in FERA due to the changes in the economic policy, because particularly economic policy had become more market friendly and liberalized through the changes in trade policy and encouragement of the foreign investment, because foreign investment must be taken up in a conducive order. Now we move on to the most important act which has made a transformation after FERA is Foreign Exchange Management Act, because with the growth of foreign players or increase in the number of MNCs and more openness to foreign capital, the management of the foreign exchange reserves was realized. So this was passed in 1999 when Indian economy was largely driven by the service sector. Service exports were booming up. So at that point of time, foreign exchange was accumulated to a larger margin, and thereby it calls for a better management expertise. So the main objective of the FERA, framed against the background, was to go for a conservation and proper utilization of the foreign exchange resources of the country. But there was a demand for certain minor modification, and that is improving the foreign exchange position. So a new act came up which replaced FERA. So this new act is Foreign Exchange Management Act. So here we look for what are the requirements of this FEMA. The first requirement is demand for new legislation, which basically on two main counts. FERA was introduced in 1974 when India's foreign exchange reserves was not satisfactory, because at that point of time Indian economy was absolutely following an inward oriented model, more towards import substitution and less towards export promotion. So at that point of time, Indian economy was absolutely taking up a kind of a closed economic framework. So some of the controls, restrictions were there on the foreign capital, so that the foreign currency cannot be shared with the globe, or any kind of drainage or outflow needs to be checked. But with the FERA Act, or with the demand, we can say that explain the need for FEMA. So the need for FEMA was basically on two constraints. One, the foreign exchange position was not satisfactory, and secondly, some controls needs to be imposed on it so as to utilize for the best interest of the country, because country was actually on a self-sufficient mode of growth. That was the major objective of Indian economic policy before 1990s. But then we are opened up in 1990s, where foreign exchange accumulation started coming up. But with the advent of the year 2000, which is actually driven by the service sector, the Foreign Exchange Management Act came into effect. So what are these referring to? This refers to the laws relating to the foreign exchange. Procedural matters were made so that the foreign investment becomes more convenient, more easier, and more accumulation of foreign exchange can take place. That means the mode of the foreign exchange needs to be more and more broader, more wider, and rationalization can take place. So we now move on to some of the major points of difference between the FERA and FEMA. This is a very important discussion because FERA and FEMA are distinguished all the times, but is actually the origin of the FEMA is from the original or the traditional Foreign Exchange Regulation Act. So we will move according to the points of comparison. The first point of comparison is the content. So in terms of the content of the FEMA of 2000 compared to FERA of 1973, we can see that the number of sections are more wider and more broader, because this also takes care of some penal provisions because of any defaulters, any kind of fraud that can be associated with this activity. On the other hand, with the FERA, it has 81 sections. Now we go for nature. Basically, FEMA is a civil law because it has been recognized as a civil law under the regulatory norms, but FERA was considered as a criminal law under the issue of 1973. Applicability in terms of the FERA, that is Foreign Exchange Regulation Act, is applies to all branches, offices outside India which are controlled by a person resident in India. So basically it is being considered to all the branches, And FERA applies to all citizens of India and to the branches outside and branches and agencies outside India. So that means it is more citizen specific, but FEMA is actually institutional specific. New terms like capital account transactions, current account transactions, all these are defined within the FEMA Act because already the country has witnessed capital account convertibility or current account convertibility already within the economic policy. And within the balance of payment, these two are segregated. So basically, capital account and current account transactions are coming in. Next, we come to the penalty. So when we refer to the penalty, then it is said that it can be quantifiable. You limit it to 3 times under the concept of FEMA, but with FERA it is 5 times. Object is very clear, that is to encourage external trade, because 2000 means it's a global economy, liberalized economy, free market economy, where the objective is very clear to encourage external trade. But when we refer to FEMA, it is basically control and regulate and sometimes prohibit the foreign exchange transactions. In case of the FEMA, there is always a kind of a compliance or which can have a full right to the legal help. This is very important because the legal issue is there where they can take the help, but in case of FERA, no such thing. Power of police authorities, this is regarding the restrictions which can be imposed. So the power is given, has restricts to a greater extent, but in case of the FERA, extensive power is being given. Because in case of the Regulatory Act, it is committed as a criminal law, so it comes under the jurisdiction of criminal law where extensive power is being given. Now the definition of authorized person is basically including the banks, offshore banking activities within the arena of international finance under FEMA, but under FERA it is limited in the case because it is individual specific. Residence also comes under with Income Tax Act, but in case of FERA, no such proper or accurate definition is being stated. So we can see that how can we highlight the differences between the FERA and the FEMA in terms of the points of comparison like content, like the delivery, the reach outs, and also in terms of the terminologies that are defined in it. So with this, we can say that with the advent of the foreign exchange market, there has been change scenario of the 1990s, which also explains how the trade landscape has changed with thrust on export. More items have become freely exportable. Export profit is exempted from the income tax at that point of time. Higher royalty and export commissions are set up, and special incentive for EOU, Export Oriented Unit, and Export Processing Zones, that is EPZ. These are some of the units which were given special focus in terms of the change scenario of Indian economy. Moreover, we can also invite some of the major players, for example, RBI for implementation, refinancing of commercial banks takes place. Commercial banks also provided short and medium-term loans. Exim Bank, which is very, very important, which is Export-Import Bank, which looks after the post-shipment finance, and it is also one of the platform to motivate or encourage the potential and the budding exporters. And one of the most regulatory body which is under the establishment of RBI is ECGC, Export Credit Guarantee Corporations. So this Export Credit Guarantee Corporations looks after the betterment of the exporters, encouraged outward oriented move in terms of the provision of midterm loans, and also reduces the political and the commercial risk. So any kind of interactions, any kind of discussions with the officials of ECGC, and also ECGC takes care of some of the insurance issues related with the export market. So this also takes care of some of the advantages of the export financing, like expanding the market share, minimal paperwork. Mostly it is done through demat account or the paperless accounts. It is also prompt, having a 24/7 delivery, providing the credit in a more flexible rates, and the source of funding also needs to be accumulated in this regard. So in this particular module, we are basically referring to the regulatory issues of foreign exchange market, particularly the FERA Act, which is Regulatory Act, the Management Act, that is considered the management of foreign exchange, how the transformation takes place to FERA to FEMA, and also identifying the major points of difference, and more importantly with the change scenario of 1990s, how the proper modes of export financing can be done. and how it can benefit the potential exporters. And then only the country can come up with a strong reserves of foreign exchange for a safer and sustainable future.